In the past easing cycle, stock did very well when there wasn't a recession. Do you think that can happen again this time?
I guess the $64,000 question is whether or not we'll have the recession. I mean, we at Wisdom Tree believe that we will not. And it does depend on the cycle. I mean, you immediately think of various crises that we had historically where a U.S. recession was delayed. I'm immediately thinking of crises that were on the other side of the planet. For example, 1998, you had long-term capital management, which was right here in the United States, but you had the Asian crisis at the same time. You had the Russian ruble collapse of 1997, but nobody associates 1999 with poor returns for, let's say, the NASDAQ composite or the S&P 500. And that was a situation where we were able to avoid recession after Alan Greenspan had cut rates. There was also that 1995 mid-cycle slowdown concept. And of course, that coincided with the onset of the early stages of the dot-com boom. And of course, that's 1995 to 2000 was a wonderful time for stocks. And you start to think about, well, what Kevin was noting, a series of Alan Greenspan style 25 basis point cuts. It's a fundamental difference from, let's say, Bernanke, where it was just slash rates, because we were in a crisis consistently. And it didn't matter how much you cut rates. It wasn't going to change the fact that the economy needed to reach a depression in 2008. I think this is a very big difference in this current environment. The first digit on U.S. unemployment right now is 4. It's something like 4.3%. There is a labor market slowdown, but it's not a labor market collapse. And so, yes, you have a situation here where they're gently easing policy, perhaps in a series of 25 basis point moves, down into the 3s, but not down to 1 or 0. It's not necessary to do that, or at least from our perspective here in September of 2025. And they're doing it from a starting point where the S&P 500 is at all-time highs. It's a peculiar situation.
You see the upside limit in S&P 500?
An upside limit. Well, no, I mean, I think if you look at what's going on in the marketplace right now, gold continues to make its ascent, all-time highs, clearly blowing numbers like the 2011 highs out of the water. Silver tagging along and surging by a greater order of magnitude, which would seemingly, if we're to believe the silver price, and to some extent the copper price, which isn't rallying as much, but is still in a stealth bull market, these are silver and copper industrial metals that are seemingly indicating economic expansion. There's not too many people talking about economic expansion right now, but easing policy into a situation where those events are occurring, easing policy into a situation where the U.S. banking system has increased loans by 4.6% year over year. To hear the rhetoric and the discussion points, you would think loans may be in a state of red ink or decline. Why else would you ease monetary policy into a situation like this? And so one of the risks, if we're to use the term risk to describe it on the bell curve, would almost be a melt up in the S&P 500 from a starting point of 21, 22 times forward earnings. It could be that they're making a foolhardy policy easing, something that may be too aggressive with a lot of indices and a lot of asset classes at all-time highs.
Do you have any price target for the S&P 500 in this year end or next year end?
Well, one of the great things about being at Wisdom Tree is we don't have to do that, which is great because then you can't hold us to anything. But we've been saying that we're cautiously bullish on the market, mostly because there are a lot of people who are still hyper-focused on tariffs as being a primary risk for capital markets. And one of the things that we think of as it's subjective analysis. There's no concrete data that we can point to. But it's one of these ideas along the lines of Donald Trump came into office on November 4th. There has now been, we're approaching a 1-year anniversary of corporations being able to adjust their business models, adjust their negotiations with counterparties, suppliers, or if they are the supplier themselves. And at some point, you get to a state in the markets where if you want to be bearish, let's say the S&P 500, you need to start finding something new, some new event in 2026 that could bring it forth, because I think there may be even a tariff fatigue concept in this market. A prime example, the up and to the right action in the Kospi, one of the greatest performing asset classes of the year. You would have never conceptualized it if we went back to December 31st and said, look, this is what will happen in 2025. And some of the best performers would be the Kospi, Hang Seng China Enterprises Index, the Nikkei 225. These are the massive exporting economies. And they just refuse, generally speaking, to decline by any order of magnitude.
I saw last year's your report about the Korean market, and then you were so bullish. And then after a year, Kospi rose about 40%. However, nowadays, with the tariff and global headwind, the Korean economy has been weak. And what's your outlook now for the Korean market?
Well, and this is one of those things where when we say the Korean market is weak, does that statement surprise anyone? It's known. It's known that it's weak. And all that matters for stocks is what happens from this point onward. Problem would be if it got weaker. But from this moment forward, the first digit on GDP for that country this year will probably be a 0 on a year-over-year basis. But it's a known quantity. Everyone knows it. And so that's something that I think is heartening when you think about the meeting of expectations with reality. The other thing, and we've been saying this for some time, I mean, value up needs to, there needs to be some more success on that front. We still have sub 10s on society-wide return on equity in Korea. And one of the things that had always been part of my concept was that Korea was going to follow the playbook of the Japanese, and the Japanese still need to do a lot of work to get their return on equity up to S&P 500 style levels. But we'll have to see whether or not there can be success in value up. There's been some fits and starts on that front. But one of the other things that I've been pointing out for many years in various markets, we used to point it out a lot with European markets when German bunds, for example, were trading at negative levels, was the earnings yield that you can have on a country's stock market relative to the bond yield available in a 10-year sovereign, a 30-year sovereign, and so forth. And if you look at the Korean yield curve, every bond on the sovereign side, 2 point something. In the shorter end, 2.25, 2.25-ish, something like that. On the long end, 2.75%. And if you take a look at this market, it's a lower quality stock market. The corporations are not nearly as profitable as Alphabet, Meta, and so forth. But on forward earnings, Korea's at 10 times. And so 1 divided by 10 is 10. That's the earnings yield. And so if you look at it for a spread basis relative to what is available in the sovereign, call it 700, 750, 775, depending on which sovereign you select. That's the margin of safety for engaging Korean equities. And that's from this moment on, from this moment forward, after the Kospi has already run inexorably higher in the last, well, in particular in 2025.
Let's go back to the America, US market. If the Fed keep cutting rates, a lot of people say the market will have a benefit. And a lot of people say the valuations are stretched, just like you. And do you worry about this easing cycle could fuel another bubble like 1999? You're talking about 1995 or 1998, 1999. And which year is similar to this year?
It could be 1999. That's a distinct possibility. I mean, we've pulled lately, I was pulling the S&P 100, and we found that something like 27% of the valuation of the S&P 100 was trading above 10 times sales, which is the famous Sun Microsystems CEO quote from the aftermath of .com was, that Sun Microsystems had been trading for north of 10 times sales. So I think that there's certainly valuation issues in the United States, and I think we would all acknowledge them. It's just a matter of how much higher things can go. If you look at the stock market's internals here in the United States, it is a market with broad participation. We've often talked, the old concept of the FANGs became the Magnificent Seven. Now, I suspect we should be adding Broadcom and Oracle into that, and maybe it's the Magnificent 9, 10, 11, who knows? But as you think about what's going on in the market right now, the market's internals, one of the only weak spots in the US stock market right now is consumer staples. And that's okay. Industrials are in rude health. That is a market that is participating to the upside. We have some nascent indicators here in the United States that there could be some banking consolidation, the good kind, the good kind of banking consolidation, not UBS and Credit Suisse, but that the big majors would have a green light from the Trump administration to acquire regional banks. And so you can get a regional valuation, you can get a bank revaluation on that front. And the banks are rallying this year. Communication services rallying and outperforming the market. Tech, that's a cyclical sector. And really the only weakness is in real estate and consumer staples, candy bars and office buildings, that type of thing. And so that is a market that is generally healthy. One of the things that we suspect, we will have to see if it ever manifests, because large caps have beaten small caps for so long, is there is this concept that small cap companies do have more floating rate debt. And to the extent that Jay Powell decides to spend 2026 easing policy in 25 basis point increments, or maybe every other meeting, or I don't know, that would benefit those who have a lot of debt that is refinancing here and now. That's the small and micro cap names.
Is this a time to buy a Magnificent Seven or stay away? I think you prefer the small caps and other cheap stocks.
Depends on your horizon. I mean, must someone suppose someone is not bullish on the Magnificent Seven or Magnificent 9, 10, 11, however many there may be. Must you go to zero? Or would you be better off doing something like an underweight so that you're still playing a quasi exposure to the S&P 500 or the Russell 1000? But do you have to be so bold in going to 0% in these mandates? Probably not, especially if you're youthful, you have a long horizon. You could be bearish on these groups without being such an extremist. And so one of the things that you could do if you're not keen on the Magnificent Seven, I have my bouts of skepticism due to my formative years occurring during the dot-com bubble, is to simply underweight them, engage large cap value mandates, engage smart beta mandates, and rather than going for the reflexive urge to go into an S&P 500 tracker fund, simply find a fund that holds them in smaller quantities. And I think WisdomTree does that in many of our funds. We have other funds that have a ton of Magnificent Seven.
Will the AI investment boom keep going?
I don't know. One of the things that is going to increasingly be in the conversation with respect to AI is everybody needs to keep going into their wallet to spend tens of billions of more dollars in building out the infrastructure. And there have been parallels made, and we don't know, to the laying of the fiber optic cable 30 years ago for the dot-com revolution and internet telephony and what have you. You see things, and we don't cover Oracle. I don't have any more insight into OpenAI than anyone else. But you see things like inking a $300 billion deal with OpenAI. $300 billion is a lot of money. Will that end up materializing? There are some of these vibrations through the system that we're seeing where I don't know if they can come up with this amount of money in 2027, 2028, 2029. We don't even know if OpenAI will ever be able to turn a profit. And so it's one of these concepts where we're still so early stage. I think the technology itself is so promising, but is there too much in this hype cycle and so many moving parts with, for example, on the chip side with Chinese chip development Where does that end up going? And the proper way to assess that is nobody knows. Nobody. I don't. You don't. Nobody knows where the chip business ends up going. And so you need to look at these things with a degree of skepticism. For example, NVIDIA is now 8% of the S&P 500. And if we look at our American asset allocators, they might own 60, 70, 80% US equities. They're holding more in one specific name, whether they like it or not, when they're doing Russell 1000 or S&P 500 tracker funds, than they're owning in entire economies. Japan is something like 5% of the global index. China's even lower. They were talking about the Kospi earlier, even lower, a couple percentage points. And they will own more NVIDIA than some of these other economies combined. It is a concentrated stock exposure, and it's a primary risk in terms of asset allocation and portfolio construction.
What's the biggest risk you see right now? Tariff no longer a concern. Some say Trump and Xi could strike a big deal by November.
You know, one of the things I think with you referenced tariffs, it does seem that we've coalesced around a new number here, which is 15. Earlier in the year, we thought it might be 10. And so that's now been re-rated upwards. I think a prime example is with the South Koreans, the number is 25. And will it get to 15% on the tariff, this moving part of $350 billion of U.S. investment? Will it come or not? These are things that continue to hang over the market. But again, I don't know if they're particularly a surprise or anything new. In your discussions with Kevin, in terms of the bond vigilantes, we've seen some bond vigilantism in some foreign bond markets. And I think that's a primary concern for stock markets. All summer long, the French bond market was extremely topical and it was a troubling development. The UK bond market, I mean, to the extent that we're engaging British equities, you don't want to see ructions in the long end of the gilt curve. And the Brits have a major problem with the 2022 Liz Truss moment, essentially the implosion of the LDI investment concept in that country. And the other one that WisdomTree specializes in to a great extent, we're number 2 in assets under management in US domiciled ETFs for Japanese equities. It's us and BlackRock. And we don't want to see 30 and 40-year Japanese JGBs having an upset stomach. Now, JGBs have decided to calm down and move sideways in yield for the last, what do you think, 30 days or so? But that's a primary risk and something we keep our eye on. And it goes back to the concept I had been talking about a few minutes ago with respect to the South Korean yield curve and the 10% earnings yield on South Korean equities. In a nation like Japan, to the extent that the bond market is selling off, along with generally everybody's bond market, it does put a little bit of a damper, if you will, on some of the rationale behind that country's equities. And it's something that we keep an eye on because across the models business at WisdomTree, across our research, Japan is a country that we frequently pound the table for being bullish on. And that would be, if I picked one thing to be a primary risk for markets, it would be that concept.
My last question. What asset do you most bullish you recommend right now?
Well, it's Japanese equities. It's Japanese equities and regional equities in general. I think that we have a lot of asset allocators who have been underweight several East Asian economies for some time. I think that there is still some room in corporate governance reform in that country. Like I stated earlier, in Korea, we say the jury is still out. The jury is still out on value up. That might be something that could kick in for Korea in a future year. But we have in Japan a concept whereby buybacks over the last 15 years have accelerated at a much faster pace than the S&P 500, dividends at a much faster pace than the S&P 500. And there's still a lot of cash left on Japanese balance sheets available to continue to increase these payouts. When we pulled the other day, I pulled the shareholder yield for MSCI Japan, and it's 3.93 is the shareholder yield, which is the sum of the dividend yield and the buyback yield. Well, that's 200 basis points more than the S&P 500. And I simply don't think that the typical American asset allocator is fully aware of that 200 basis point margin. I think that it is still thought of as a culture that has a low yield because of all those decades of zero interest rate policy by the Bank of Japan, which is now essentially over. There are a lot of, when we talk to US investors, whether be they broker dealers, RIAs, what have you, the exposures to Japan can be measured in low percentage points, if not 0% in many cases. That is a wave of money that could come. And it's likely my best idea. It's been my best idea for some time, and I'm going to stick with it.
How about the Chinese assets, Chinese stock, like tech, Alibaba, or?
This is another one. We had our colleague, our resident sinologist, Li Shen Ren, on one of our webinars that we do at WisdomTree, which is called Office Hours. And one of the things with China that she was pointing out the other day is the concept of the 996 perhaps being ameliorated. And the 996 is arrive at work at 9 a.m., leave at 9 p.m., and do this 6 days a week. Well, the Korean viewer can identify with this concept. And the Chinese have a concept of involution, which is essentially this hyper competitiveness among Chinese corporations where profit margins are this big, ever so slight, and the inability to essentially print robust profits. And Xi Jinping is attempting to change that. We'll see if that ends up being the case. Should that manifest, then you can get more upside in Chinese markets. Now, they're no longer as cheap as they were about a year ago. I referenced the Hang Seng China Enterprises Index if we're going to speak to Hong Kong equities. It's essentially doubled off those lows around 5,000, now threatening 10,000 on that index. And when we were pulling our own, the WisdomTree China ex-state-owned enterprises index, it's Chinese equities kicking out the SOEs. We are about 18 times forward earnings. And so that's not, at one point it was down on around 11 or 12 times forward earnings. And so that should be a continued obstacle, but we are steadfastly bullish. We think that in terms of who will be giving fiscal stimulus over the next 12 months, it won't be the Americans. The Americans are tightening fiscal policy as evidenced by the tariff regime. It is the Chinese. The fiscal stimulus is going to be coming from China. That's another underappreciated upside risk for capital markets.
It was my last question. Thank you for again taking the time to speak with us.